Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into company reports and find the juicy details you actually care about. Today we are unboxing Roku in C's latest 10Q filing for the quarter ending the 30th of September 2025. Get ready because things are about to get interesting as we see how their streaming empire is really doing. Before we dive in, if you appreciate getting straight to the point insights from these massive corporate documents, make sure you subscribe to the channel. We also have a fantastic Discord community, linked in the description below, so come join the conversation. Alright, let's get straight into the numbers. Looking at their balance sheet as of the 30th of September 2025, Roku had about $4.4 billion in total assets. That is up slightly from the end of 2024. What is interesting here is their cash situation. They had $1.57 billion in cash and cash equivalents, plus another $726 million in short-term investments. So they have a pretty healthy amount of readily available cash. Now let's talk about money owed to them. Their accounts receivable, which is basically money customers owe Roku, was $745 million at the end of September 2025. This is down from over $812 million at the end of 2024. While a decrease in accounts receivable can sometimes mean people are paying faster, that also means less money is coming in right now. They also show allowances for sales returns and doubtful accounts around $60 million, which is a good buffer. This section called Goodwill caught my eye. Goodwill is basically what a company pays for an acquisition above the fair value of its net assets. Roku's goodwill jumped significantly from $161 million at the end of 2024 to over $309 million by September 2025. This huge leap tells us they made a substantial acquisition and are betting big on it. Now let's look at their income statement to see how they performed. For the 3 months ending the 30th of September 2025, Roku reported total net revenue of $1.21 billion. That's a nice 14% increase compared to the same period last year. Their platform revenue, which comes from advertising and streaming services distribution, saw a strong 17% jump to over $1.06 billion. This is clearly the engine driving their business. On the flip side, their devices revenue, including streaming players and smart TVs, actually dipped by 5% to $145.9 million. It seems they are prioritizing growth in their platform over making big profits on hardware. Overall, their total gross profit increased by 9% to nearly $525 million. Even though the devices business is losing the money, the booming platform business is more than making up for it. When we look at operating expenses, research and development stayed pretty flat at around $182 million. They are investing steadily in new tech. Sales and marketing expenses went up by 2% to $242 million. They are spending more to get their message out. Interestingly, general and administrative expenses actually decreased by 9% to $91 million. This could signal a more streamlined back office. Despite the revenue growth, their income from operations was just $9.5 million for the quarter. That is a pretty thin margin considering their size. Thankfully, other income net provided a boost of about $28.5 million. This likely includes interest earned on their investments. They paid about $13 million in income taxes for the quarter. And that brings us to the bottom line. Roku reported a net income of $24.8 million for the 3 months ending the 30th of September 2025. While this is a big improvement from a net loss of $9 million last year, it is still not a massive profit given their total revenue. It is worth noting that their diluted weighted average shares outstanding increased to 151.5 million. This means they are issuing more shares which can dilute ownership for existing shareholders. Going through the notes, we see some restructuring charges in the 9 months ending the 30th of September 2025. They recorded about $3 million in charges related to facilities and impairments. This suggests they are still trimming the fat where needed. Now, for a detail that really makes you think about their strategic bets. Under fair value disclosures, we see their strategic investment in convertible promissory notes. As of the 30th of September 2025, these notes were valued at $43.4 million. It's a level 3 asset, meaning its valuation relies on unobservable inputs. They are essentially making a bet on a partner company that could pay off big or not at all. Even more interesting is the contingent consideration related to a recent acquisition. This contingent consideration is valued at over $67 million. This is part of the price they agreed to pay for a company dependent on future performance. It shows they are willing to pay for growth, but are also hedging their bets. Let's quickly touch on debt. In September 2024, Roku entered into a credit agreement amounting to $300 million. As of the 30th of September 2025, they had not borrowed any money against this line of credit, and they had $39.5 million in outstanding letters of credit, so they have access to funds if needed but are not currently leveraged. In stockholders' equity, we see they repurchased about 567,000 shares of their class of common stock in the quarter for $50 million. This is a way to return value to shareholders by reducing the number of outstanding shares. It is not a huge amount relative to their total shares, but it shows a commitment to shareholder value. This section on equity incentive plans shows 13.1 million shares reserved for future awards. This is quite significant and is a way they attract and retain talent, but it also means potential future dilution for shareholders. Looking at their commitments, they have over $500 million in future commitments for content manufacturing and other obligations. A large chunk of this is for content which is crucial for keeping their platform engaging. Note 17 on restructuring charges details some pretty significant charges in 2024, primarily related to facility exit costs and asset impairments totaling over $30 million for the 9 months. While the current 2025 numbers are much lower, it shows they previously made tough decisions to streamline operations. Now let's get into management's own explanation. They are clearly focused on growing their platform revenue, which is their highest margin business. They also mention managing device prices to boost streaming households, a strategy that should theoretically funnel more users to their platform for monetization. They streamed 36.5 billion hours in the quarter, up 14% year over year. This metric is key for them as more hours streamed means more opportunities to show ads and generate revenue. Platform revenue growth is highlighted as a strategic priority with a 17% jump in the quarter, which is excellent. Now for a key number management uses to gauge profitability adjusted EBITDA. For the quarter, it came in at $116.9 million, up from $98.2 million last year. This shows they are becoming more efficient and profitable. And what about cash generation free cash flow for the trailing 12 months ending September 2025? Was a healthy $443 million, significantly up from $157 million last year. This suggests they are generating strong cash from their core operations. Alright, let's talk about the storm clouds. Their risk factors section is extensive and frankly a bit scary. They face intense competition from giants like Amazon, Apple and Google, not to mention Walmart and even their own television partners who might develop competing solutions. The advertising market is also a constant battleground with established players and new streaming ad tiers from Netflix and Disney increasing the pressure. They are heavily reliant on content partners and a few major apps account for nearly half of their streaming hours. If any of these relationships sour, it could seriously hurt them. This risk factor basically says if they don't stand out, they will lose users. Simple as that. Competition for eyeballs and advertising dollars is fierce. This risk statement is a recurring theme and it's alarming how many times it pops up. It highlights the precariousness of their position. This is a pretty straightforward way of saying if they don't keep innovating and offering something unique, they will fall behind. They need to keep their platform fresh and compelling. Then there is the constant threat of cyber attacks and data breaches. With so much user data, they handle a major breach could be devastating to their reputation and lead to massive lawsuits. And of course, the big picture macroeconomic factors like inflation, interest rates, and geopolitical conflicts are always a concern impacting consumer spending and advertising budgets. So what is the story here? Roku is experiencing solid growth on its platform, aggressively expanding its advertising and streaming services distribution. The platform revenue up 17% is a great sign they are effectively monetizing their user base. However, their devices business is a bit of a drag, seeing declining revenue and negative gross profit margins. They are essentially selling hardware at a loss to gain users for their more profitable platform. This is a risky bet, but one that could pay off if their platform monetization continues to soar. The massive increase in goodwill indicates a significant acquisition which could be a game changer if it succeeds, but it also carries a substantial risk. Their cash reserves are strong and they have access to credit, but they are also carrying significant future commitments for content and manufacturing. The risks are very real. They face intense competition from tech giants and a constantly evolving regulatory landscape. Their reliance on a few key content partners and the constant battle for advertising dollars are significant challenges. The increasing focus on data privacy also presents both risks and opportunities. Ultimately, Roku appears to be in a transitional phase. They are doubling down on their platform strategy at the expense of device profitability. If they can continue to grow their user base and effectively monetize their platform while navigating intense competition and regulatory hurdles, they could continue to thrive. But if their bets on acquisitions and platform growth don't pay off, it could be a tough road ahead. Alright, that's the breakdown of Roku in C's latest financial report. What are your thoughts on their strategy? Are they making the right bets for the future, or are the risks too great? Let me know in the comments below. If this deep dive helped you understand this filing better, please hit that like button. It really helps the channel keep growing. And of course, subscribe for more corporate breakdowns like this. Don't forget to join our Discord community linked in the description for more regular discussions and insights. Thanks for watching, and I'll see you in the next one.